Good afternoon to everybody here in the AGSIW offices in Washington, D.C., and good afternoon, good morning, or good evening to everybody in our video audience around the world. I am Doug Silliman, the president of the Arab Gulf States Institute, and I'm very pleased to have you all with us today for our program, The Economic Outlook and Future Policy Challenges for Saudi Arabia. Let me introduce to you our panelists for the day. First, we have Dr. Garbis Iradian, the chief economist for the Middle East for the Institute of International Finance. He, like everyone on the team here, is either with or was with the IMF at some point in the past, and he oversees the IIF's work on Lebanon, Saudi Arabia, the UAE, Morocco, Algeria, Libya, and the GCC. We also have with us Dr. Amine Mati, who is the assistant director at the IMF for the Middle East and Central Asia. He has been, since early 2022, the IMF's mission chief for Saudi Arabia and the head of the IMF's Gulf Cooperation Council program as well. And moderating our discussion today is Tim Callen, who is a visiting fellow here at AGSIW, but also used to work with the IMF and was previously the mission director for Saudi Arabia and for the GCC. Now, I've given you very quick readouts. We have the full bios for all of our panelists and all their impressive work in the past at agsiw.org if you are interested. So with the preliminaries out of the way, Tim, the microphone is yours.
Thank you very much, Ambassador, and let me add my welcome to today's event. I think, as most of you know, the IMF has released its annual report on the Saudi economy, the so-called Article 4 staff report, a couple of weeks ago. So that will form the basis for the discussion and the background. Of course, Garbis as well has been doing a lot of work at the IIF on Saudi. So we have two very talented and in-the-know economists here to discuss the economic and policy outlook for Saudi Arabia. So without further ado, let me maybe kick off the discussion and first ask Amine if he could sort of set out what he sees as the outlook for Saudi Arabia for the rest of 2023 and into 2024, given we've been seeing oil production cuts extended, tightening of monetary policy in the US and in many other advanced countries, and what the IMF seems to be projecting in terms of a fiscal consolidation going forward. So maybe you could start with that, Amine, and we'll go from there.
Thank you, Tim, and thank you, AGSIW. I look at that to make sure I get all the acronyms right before having me here, and good to be in the panel with old friends who used to be at the IMF. In terms of outlook, if you look at what we are expecting for Saudi Arabia in 2023, we have growth. So first of all, 2022 was an exceptional year where Saudi Arabia was the fastest growing economy in the G20 at 8.7%. We expect a slowdown this year to 1.9%. That was before the additional oil production cuts. We're going to have a new WEO, or New World Economic Outlook, is going to come in October. We revise that to account for some of this. I can give you one hint. The headline growth, overall growth, will be lower, but still positive than 1.9% for 2023. But what's important to note is that non-oil growth, which was 4.9% last year, is expected to be maintained. The momentum will still be driven by consumption. We have private investment. Last year, private investment grew, non-oil private investment grew by 45%. We still expect a double digit. We have this project implementation from the Giga projects. The reform implementation is ongoing. We've seen sectors that, wholesale, retail, manufacturing are holding. Tim asked a question about global tightening. Global tightening in terms of the impact on the economy, we see the impact muted. We have liquidity that is still there. Deposit growth is still healthy at 9-10%. And we've seen a shift in deposits from demand to time and saving deposits that is quite consistent with the increase in interest rate. But the credit growth is still quite healthy, and we expect that to remain in double digits. And one thing to look at that is that in terms of liquidity in the systems, as long as oil price is higher than a certain level, Last year we looked at oil price higher than $40, $50. When the global tightening is happening, the impact on the economy is still muted. So for 2023-24, to answer your question, Tim, we still expect non-oil growth to go back to remain quite robust, driven by strong domestic demand.
Okay, thank you. I mean, maybe Garbis could ask you whether the IIF economic outlook is broadly in agreement with the IMF, and maybe you could also then touch on the inflation outlook. And one thing I think that's particularly noticeable is that inflation in Saudi Arabia has stayed very well below the levels we've seen here in the US or in much of Europe. So maybe shed some light on that for us.
Yes, thank you for the invitation. We broadly share the view of the IMF on the non-oil real GDP growth, which I think will be around 5%, driven by consumption and investment. However, the overall growth, our recent calculation, which was in September, just after the decision of Saudi Arabia to extend the production cut of 1 million barrel a day till end of the year. So we revised the oil production, and the overall growth would be hardly 1%, and that's mainly because it's dragged down by the lower crude oil production, which could decline on average by 6 or 7%. We also differ a little bit on the assumption of oil prices. I guess in the Article 4 consultation, the IMF is using $78 per barrel average. We're using $85, which is so far has been consistent with development. Even if we assume for the rest of the year that Brent oil prices stay around $95, the average for the whole year would be $85. So in terms of its impact on the current account, in the balance of payment, on the fiscal, the drop in oil production in our scenario will be offset mostly by higher oil price assumption. In case of the IMF, they have lower oil production. You have higher oil production and lower oil prices, which offsets. The result overall would be a fiscal deficit, which is around 1% only, and current account surplus narrowing from around 15% last year to something around 4 or 5%. So overall, it's the same outlook, except these some technical issues related to the oil production. And we should note that in case of oil exporting countries, the GCC, what counts is the non-oil real GDP, because that's the main reflection of economic activity. More than 98% of the labor force work in the non-oil sector. So that's what we have to look at. And when you mentioned that the growth was the highest among the G20, even if we don't take the overall growth last year, which was driven partly by the crude oil production, non-oil real GDP growth of 5.4% is considered robust, very high growth.
Right. Okay.
Tim, if I can come
Yes,
on this.
please.
I mean, on this, just to clarify the IMF projection, I think the cutoff for the Article 4 was obviously, we went to our board in July. As I said, we will update the numbers, but I'm sure even Garbis numbers will change now in terms of the futures oil price, what is expected for next year. And we will update also our current account and fiscal account. Maybe one quick rule of thumb that one can look at is $10, $12 increase in oil price over a full year period would probably offset 1 million barrels a day cut in terms of the fiscal and current account. So I think you have to look at that in terms of the package.
So I think the overall message coming from both of you is overall growth to slow this year because of the oil production cuts, but non-oil growth continuing to grow pretty robustly. Fiscal and current account will probably both be weaker than last year, but probably remaining in surplus in both fiscal and current account. Is that
in
a fair
terms
summary?
your numbers will come out, but again, depending on where you are on the oil price. I think, right now we have a fiscal, 2022, we had a fiscal surplus of 2.5%. We were expecting a deficit in 2023 of 1.3. That's probably going to go closer to balance after the change in both oil price and production, because that would, on current account, is still under surplus. It's still a surplus, but would be lower.
Okay.
Yes, broadly, it's the same projection that we have, except that we think even under the assumption that the government spending will stay flat, will not increase this year, given the projection of the non-oil revenue and oil prices of 85, we still get a deficit about 1%. And this is consistent with the outcome for the first half of this year. It was a deficit. One important point for Saudi Arabia is the fiscal break-even prices of oil, which you talked a lot in the past in the press. And what happens is that it has increased to $90 per barrel. Our recent calculations show that to balance the budget, given the profile of spending, non-oil revenue, and oil production, and certain assumption on how much is transferred from the balance of payment exports of oil to the budget. It's not always, it varies between 70% to 85%. The fiscal break-even prices has risen from something around 82, 83 last year or the previous year to about 90. So which means that cut in oil production is leading to a rise in the fiscal break-even prices of oil. Of course, there are other factors also.
And maybe on inflation, before we move on, do either Amine or Garbis want to comment on factors keeping inflation in Saudi much lower than we've seen in many other countries?
Yeah. If I may say something on inflation, we've seen inflation rate in Saudi Arabia and the rest of the GCC countries much lower than in advanced economies and even most of the emerging markets. And there are several reasons for that. One, which is often cited by the IMF, is the price caps on certain products. In case of Saudi Arabia, for example, gasoline prices. Gasoline prices is 62 cents per liter. In Saudi Arabia, in the UAE, is about $1. And in Saudi Arabia, it was kept the same for the past 2-3 years. Another important factor is the flexible labor market in Saudi Arabia. Given the fact that more than 50% of the labor force are foreigners, there is no wage pressure. There is flexibility in prices and wages by adjusting the number of immigrants, foreign labor that could come to Saudi Arabia. More importantly, the third factor is that Saudi Arabia did not follow the expansionary fiscal policies that was followed in Europe and the United States. In 2020, I made some calculation that spending in Saudi Arabia was 2%, which is lower than the average inflation. So in real terms,
2% increase.
2% increase spending. In the United States, it was 23%. And then it continued in 2021, 6% increase. In Saudi Arabia, in 2021, a decline in spending. So that kept prices low. So there is no expansionary fiscal. And this is the major component which explains. The same thing in UAE, it followed the same phenomena as Saudi Arabia. Euro area, they increased spending by 9%, where when you have a deflation in the Eurozone and you increase spending. So the main inflationary pressure in the United States and the Euro area is partly driven by the expansionary fiscal policy during the COVID years.
I mean, if you look at inflation, numbers that surprise us a bit. In the past, you had wholesale price inflation double digits for Saudi Arabia for about 12, 14 months at about 12, 14% decreasing. We didn't see the pass-through in terms of consumer price inflation. Some of that, and we were looking at supply chain constraint. Some of that is also due to the basket that we are looking at. If you look at rent in the CPI basket is about 20, 21%. For a lot of that period, rent inflation was actually negative and helping offset some of the increase in inflation that we've seen. Today, we have inflation, the latest number is 2%. We had, on average, we were expecting 2.8%. Now we are going to be lowering that number. And we're seeing that food and transport prices are going down. We're seeing that being entrenched. I think Garbis also did mention that we are not seeing the wage pressures. If you look at our staff report, one of the risks that we have highlighted was risks of overheating in terms of seeing demand pressures. And would that materialize into wages or prices of products? Even though investment have increased and we've seen an acceleration in these projects, that has not materialized. So far that, so the main driver, I would say, has been some of the caps on prices that are there. And, this pass-through from global to domestic prices is happening with a lag effect. And we're seeing some of that now going the other way in terms of bringing prices down.
Okay. So before we maybe move off growth, questions come in online. It says, many analysts attribute the recent Saudi cuts in oil production to their growth interests and the fact the government needs a certain high oil price for ambitious products. But if the cuts now lead to smaller GDP growth, 1% instead of 1.9, how do they help the economy? Maybe you could just explain.
I think I'll just go back to what I said, right? I mean, the overall headline reflects the production cut. But what happens is you need to focus on what's happening on the non-oil economy, and that is growing. And actually, compared to the past, and maybe this is where the distinction needs to be looked at, there's more of a delinking between oil prices and economic activity than it used to be. Before, the main channel was oil price going up, government spending going up. That's being recycled in the economy, and that also affected non-oil. Garbis said, there's a bit more fiscal prudence and discipline, so we're not seeing that link. But we're seeing a lot of these projects, some of them financed through the Sovereign Wealth Fund, PIF, NDF, that are continuing. So we have these investment plans that are happening, consumer demand that is recovering. We have record numbers in terms of tourists coming in terms of number of pilgrims that we've seen already in July is already double what it used to be. And all of that is part of the whole economic activity that we are seeing. So non-oil growth, even though the oil production or oil revenues could be affected by a cut, is still maintaining the momentum as the reforms are continuing and some of these projects continue.
Yeah, I would add on what Amine said. I agree that the higher oil prices, in fact, is helping in a way the non-oil economy. There has been several research paper at the IMF, and we updated that regressions, that whenever oil prices are high, above a certain level, $70 or so, it mitigates the negative impact of tighter monetary policy. Mm-hmm. So we are in an environment of tight global financial conditions, yet we haven't seen that impact on Saudi Arabia, and the reason is oil prices. Growth in Saudi Arabia, the non-oil real GDP growth, historically has been driven either by the fiscal spending and also by oil prices. So if you put it in your regressions, change in real oil prices and a dummy for certain oil level, you find that a tighter monetary policy globally will be insignificant. It will not affect the overall growth. So I agree with Amine that higher oil prices is helping the Saudi economy. However, on the other side, if you look overall growth, yes, instead of growing overall growth 2.5% without the cut in production, now hardly Saudi Arabia will grow by 1%. However, if one asks the question, is it the decision by the kingdom only economically driven to cut production voluntarily? Saudi Arabia is the only country within OPEC plus. Russia is cutting probably 300,000 barrels a day, but that's what they say. Ideally, for the Saudi Arabia would have been an agreement within the OPEC plus on burden sharing, a situation where instead of cutting oil production by 1 million barrel a day, Saudi Arabia could cut by 500,000 barrel a day, and UAE, Kuwait, and other producers the rest. This wasn't the case. It was a voluntary decision. Then the question arises, what are the motives? I mean, I would say yes, economically, it's fine, but there is some element of politics here, the geopolitics in the region, in the sense that maybe the kingdom would like to put some pressure.
Mm-hmm. Okay.
Pressure on whom?
Well, I mean, United States would like to have low oil prices. Biden administration, in preparation for the next election in November, would prefer not to see gasoline prices reaching around $4 per gallon. And that's one factor. However, there are certain signs I see in the Saudi initiative that they left the doors open for further reconciliation between United States and Saudi Arabia. So I wouldn't be surprised next year that Saudi Arabia will start increasing production. And that could drive oil prices significantly below $80. It could drive to 75 or so, which is our projection also for next year. Definitely oil prices will be much lower than the current production. Another positive indication also, probably we might talk about it, is the US initiative in collaboration with the European Union and India on the Indian corridor, where Saudi Arabia said, we will study it, we will not join that position. We will take the decision by January 2024. So this is sending a signal to the US and Europe that there is a scope for some cooperation.
Maybe we'll come back to that later in the discussion. Just as a reminder to please, if you're online, send any questions in, and if you're in the room, have any questions, please just indicate the name tag. Maybe you will ask one more, and then we'll turn to some questions in the room and online. And I guess one of the things both Amine and Garbis have mentioned is the importance of non-oil growth for employment in the labour market. And we've seen pretty impressive employment growth for Saudis, the unemployment rate coming down. I wonder, Amine, if you can shed any light on how you see the role of strong growth, but also then there have been quite a lot of reforms in the labour market as well, how those two are playing a role in this employment growth, and whether then there are any concerns in terms of the wage levels of these new jobs that are being created, which seem to be generally around the 4,000 rial level, and whether that's sort of sustainable as we go forward from a social point of view.
Thank you, Tim, for that. I mean, let's recap in terms of as the economy is was recovering from COVID-19, and in terms of where we are in terms of employment, we've seen at that time expatriate labor going down. We had Saudi employment rising. We are now at a level where expatriate labor is above 7 million. It's now above the pre-COVID level. And we have Saudi employment that has risen steadily. Now we have record low unemployment level for Saudi nationals at 8%. We had total unemployment rate at below 5%. This is driven at the same time as we have we have labor force participation rates that are increasing overall. We had over the last 4 or 5 years labor force participation of women that have gone up from 17% to 36%. Who would have thought that in 4 or 5 years you would get that? What was driving that? Obviously, you had all of these labor market reforms, the anti-discrimination laws, you have the equal wage, we have also reform of the kafala system on the expatriate. All of these have helped. We are seeing now, obviously, growth in terms of jobs into the service industries, retail, manufacturing. So a combination of both the reforms and the growth in different sectors. In terms of wages, I'm not sure if I fully agree with the perception that the new wages are only low skills, right? I mean, if you were to look at 2021, for example, 22, 55% of the new jobs that were coming for Saudi nationals were professional jobs. And jobs that required, a degree or higher degree were the ones where they had the most growth. We've seen that growing for Saudi nationals. We've seen that growing in terms of the wages. Where we've seen pressure actually on wages is that the unskilled wages have gone up by 12% in 2022, and that could also be because you have a lot of these projects coming in and a lot of, for retails, etc. We have a lot of employment for some, but that's not necessarily the Saudi nationals that have those jobs, right? So I think that could be something where we have to look at the reform on the expatriate side. In terms of Saudi nationals, the increase that we are seeing, we expect that to be sustained. We have a lot of these programs in terms of human capital development, education, a lot of those new, if you look at the new Saudi workers, we've seen a shift in terms of the new employment because you don't have jobs in the government sector growing. We have now shifting in terms of the new employment. We've seen Saudi nationals' employment on the private sector in terms of 2022 has grown by 15%, and this is the shift that we are seeing a lot more.
Okay, very good. Maybe I can turn to some questions in the room, and maybe start with Jonathan, and then work our way round, and then we'll go to some of the online questions. So, Jonathan, the floor's yours.
Wait for the mic. Thank you. Garbis, your comments about increasing oil production in 2024 were very intriguing. It makes a big difference whether production is increased in January or December. Is this strictly dependent on the relationship with the Biden administration? And maybe it's a bad assumption, but isn't it probably correct that the kingdom would rather see Trump come back, if possible? So why would there be an effort to help Biden if it does turn out that Trump is the alternative?
This is tricky. I think the production cuts, given that Saudi Arabia committed themselves to keep production at the July level, which is 1 million barrel cut, through December, if they backtrack, there is a credibility issue. So our assumption is that this production cut will last till end of the year. However, next year, most likely there will be significant increase in production, something around 5% or so. This combined with higher production in United States, Canada, Brazil, the non-OPEC plus countries where production is increasing, probably weaker global demand for oil, you could see easily oil prices dropping. I mean, most of the forecast by different institutions, Citibank, Goldman Sachs, our forecast, etc., it's around between $75 to $77. If you look also at the future market prices, which the IMF uses it, because it's hard to forecast oil using certain models. It's very difficult. And historically, it has shown that the future market track oil prices much better than sophisticated modeling. Of course, you use some judgment, supply and demand. So based on our understanding, what would be the supply by OPEC plus, including Saudi Arabia, Russia, and the others, and the non-OPEC plus, and the weaker global demand for oil, you could see oil prices dropping significantly.
On this, I won't go into the politics, so I'll leave that to Garbis. But on the technical level, the way we are projecting is that we're assuming that the agreement, what was announced is what will happen in 2023, and then we assume some coming back to normal in 2024. But I think you have to look at what's the oil market, and you look at OPEC, the last numbers, they have announced a shortfall of about 3 million barrels a day coming. So that's probably going to weigh on the market. We're hearing a lot more in terms of demand coming up because of China. There's there's always this uncertainty about if there's tightening in the U.S., what will happen. So all of that is going to weigh on the oil market. And therefore, Garbis is a lot more courageous than us at the IMF by predicting the oil price. We're just going with the oil futures. Yeah. And we will update with our oil futures going forward, which will reflect some of the developments that we are seeing here.
Okay. Maybe we can move to Greg, and please wait for the microphone, which is coming behind you.
Thanks. How much of the non-oil growth is driven by the PIF's domestic investment, which is government spending in some way or another?
That's a difficult question. I think it's driven by all the projects ongoing, right? So you have FDI. If you look at total investment for 2022, it was close to 800 billion riyal. Some component of that was PIF, maybe a little less than 150 billion. But you have a lot of these private investment that has also come in. You have the public sector that is there. Now, going forward, we expect a lot of these giga projects that are going to be increasing. Some of it are PIF-led, others are not. So, it's a combination. We see it more as in terms of a global strategy as part of the implementation of the Vision 2030, right? They have targets in terms of certain investment projects. And also, when we look at investment projects, we're looking at the numbers. But what's important is the bang you get for the buck. So in terms of the high returns, are these the right projects that are going to get? And right now, we are seeing an acceleration in terms of implementation of these giga projects. So that will help drive growth, at least in the near term.
Are those going to be the ones that give the biggest bang for the buck, the giga projects?
Well, right now, they're the ones, when you look at construction and all of that, they're the ones driving the economy. In terms of this private investment, I think that helps. But let's not forget what's happening on services and retail. And a lot of these industries, for example, if you were to look at the contribution to growth, 2016, digitalization was contributing about 0.2% to growth. Now we're about 15%. Right? So in terms of a lot of those industries, obviously there's different ways of measuring that. Tourism now in terms of contribution to GDP is about 4.5%. And we've seen those numbers that are likely to grow with those infrastructures. So those are some of the other sectors that we would expect to grow as a result of all of these.
Okay. Maybe we'll come across to Robert over here.
Thanks. Rob Mogilnicki from AGSIW here. Tim and I have talked quite a bit about the PIF, and Greg beat me to the punch here, but maybe just a quick follow on there and then one other question. How would you, Amine and Garbis, describe the PIF's relationship or role in government spending? This is kind of a question we talk about quite a bit. And then, I guess on the other side of the investment equation, what's your assessment of Saudi Arabia's FDI attraction efforts? They released some time ago very, very ambitious targets for FDI, and would be very curious to get your sense of how these efforts are shaping up and the direction they're likely to take in the future, if you can give some insight there. Thank you.
Who wants to take that first?
I can say a few things. On the PIF relationship with the central government spending, we noticed that in the past several years, central government investment or spending on infrastructure has been declining even since 2015. Now the PIF is taking the leading role in these mega projects. Then the question comes, at some situation that you have to consolidate the PIF accounts with the central government like you do it in Latin America and have public sector revenue and expenditure. So far, part of the adjustment in the central government has been less spending on infrastructure, although in some of the years it has increased, but from a low base. On the FDI issue, this is very interesting. In the Vision 2030, the objective was to raise foreign direct investment in the kingdom from something around 1% in 2013-14 to 5%. So far it has been 1%. Last year it was 1%. The only jump, it happened one-off in 2021, and that was due to certain Aramco deal, it went up. So to improve productivity and achieve a sustained rapid non-oil growth, you need more FDI. And unfortunately, FDI is not coming enough to the kingdom. Foreign investors are still concerned about governance issue and other, although the business environment has improved, but there is scope for further improvement. I just compare Saudi Arabia with the UAE. United Arab Emirates, foreign direct investment in terms of the size of the economy is 4.5%, one of the highest among emerging economies. In Saudi Arabia, it remained 1%. So it's a big challenge for the kingdom. What reforms should be included in addition to improve governance and business environment to attract more foreign direct investment? And probably, Amine is more knowledgeable on those things, the reforms, which is well explained in the Article 4 consultation.
Thank you, Garbis. Thanks, Robert. On the question on the PIF, I think, I think in terms of delineation, I think you see it clearly when you look at the National Investment Strategy up to 2030. Contributions that is expected from PIF, I think 150 billion a year. They've done a bit less the last 2 years. This is expected to catch up, and in terms of project. But there's also other, it's not just infrastructure. There's also capital injection that PIF is doing. Central government spending in terms of infrastructure is there to accompany that. That's part of a medium-term fiscal framework, which is good, because that should be looked at over a medium-term horizon. And then, at the IMF and the authorities are working on that. We've been calling for this comprehensive asset liability management framework. And I think when Tim was already working on Saudi Arabia at the IMF, I think that was also a recommendation. There's progress that has been made in consolidating that, and you will see in our staff report we actually have some preliminary numbers there to try to, and this will become more and more important going forward because some of those institutions, for example, the PIF is now going into the market, right? So you have to look at it from a holistic perspective, and I think this is something that the authorities are working on in terms of looking at, if you want to look at the appropriate fiscal stance, we need to look at what's happening at the consolidated level. Now, on FDI, Garbis said it in terms of, the target for, we had the target for this year was, 2023 was like 5%. We have like 0.3% of GDP. That was last year. That fell, and that fell because, not because you have less deal, but because once you take out the Aramco deal, you have that. But the level is staying, in percent of GDP is staying the same. The investment is not yet where the authorities want to be. I think there's, but if you look at the number of investment deals and the new licenses, those have increased by 95%, 267%. So you have a lot more of those coming in. We expect that these will have an impact on investment. There's a lot that was done on the regulatory environment in terms of setting up a business, in terms of red tape. If you look at our report, you will see a lot of the laws that are there, from bankruptcy law, commercial code, in terms of there's a new investment code being done, consumer protection law. So we expect that a lot of those laws will help facilitate the climate for foreign direct investment. Of course, it's not just having the laws, it's how they are implemented that's going to matter. And I think there's a lot being done to facilitate this. We have also a lot of those companies that now are moving their regional headquarters to Saudi Arabia. I think we should expect some effect of that. So we will see going forward in next year what's happening, and particularly what counts should be just FDI, but not just in oil, but FDI also in non-oil, right?
So we have a question online following on the PIF. It says, how much influence does the PIF have on government spending and private investment? And maybe I could add on to that and just say, the PIF seems to, be establishing a new company every week in, some sector of the Saudi economy. And there has definitely been, this image of, spending shifting from the central government to the PIF. So in terms of the overall goal of developing the private sector in Saudi, is the PIF strategy of being involved in so much going to sort of support a more diversified private sector?
Well, I think what's important is that when the PIF come in, they usually, or their strategy has been to come in some industries where there is no private sector, where at this stage trying to play that catalytic effect. When they try to play catalytic effect, what's important is to make sure that you're not crowding out private sector investment. So, when they came in and they put capital initially for movie theaters, but then they exited that. They did the same for Aqua Power. They did the same for stock exchange. What's important is that if they come in with incipient capital, is that there is a clear exit strategy, there's a clear phase out to make sure that the private sector can also compete and come in those industries. I gave you examples of 3 industries, but it's important that they do it with others. It's important also to try to assess a cost-benefit analysis, make sure that they have the right returns that are coming in from those investments.
Okay. Garbis, anything you want to add on that?
I mean, in general, government-related entities like the PIF, and
I'm not
there
sure
are
they
many
will call themselves government-related. I'm
but
not sure
it's
they
public.
will call it.
Yes, it's publicly owned. Huh? It's state. In other GCC countries, you have the same situation. UAE, you have government-related entities, public sector, and they have been the main driver of economic activity in the region. I guess this is the situation which will continue in Saudi Arabia for a while, till eventually the private sector participation in the economy increases and the growth will be driven mostly by the private sector. That will be a big challenge, not only for Saudi Arabia, but also for the rest of the GCC.
Okay. Jonathan, you have another question? Yeah. Thanks. No?
Thank you. Could we just go back to FDI for a minute and maybe rewind it? Regardless of what the Biden administration wants, the world is decoupling. It's just the speed of it decouples is what we can talk about. Bloomberg Businessweek had a great analysis the other day which tracked FDI by the votes of how you voted for or against Russia in the war. I think it was really a brilliant little piece. And it showed that FDI is really concentrating among people who voted against Russia. It's staying within that block, and then there's another block where you have FDI that's really shrank. So, and Saudi has a very interesting position between the 2 blocks. So, how do you see this working out? For example, with the Chinese, essentially a clearing account, which is something the Soviet Union had 50 years ago, and with India, clearing accounts were very important. Do you see them continuing to develop this special relationship with China with things like clearing accounts and looking to China to put money into their country while they put money into China? Or is there going to be no change? What's going to happen with this fragmentation, as you guys call it?
I think the way to look at it, I think from the perspective of the country and the country's development is any investment or FDI that comes to the country would be welcome. And at the end, the laws that, there's some industrial policy being done, and I think, some risks with that should be minimized to some of the sectors. But clearly there's a strategy of developing certain sectors. There's a lot of the laws and the regulatory environment that I talk is for all kind of investment, all investors. There's no discrimination there of where that is coming from. And I think we would expect, the FDI, the targets that were done are not by region, it's by sector, if you want, and wherever those coming. So we expect that to be more broad-based. We haven't really seen that being affected at this stage by fragmentation. And in terms of the different industries, you've seen Lucid in terms of electrical vehicle production. We're seeing, other types of industries that are being incentivized to move to Saudi Arabia, irrespective of country of origin.
But de-dollarization and the fragmentation, the clearing account relationship, is this going to grow?
I haven't really seen, in terms of de-dollarization, we haven't really seen that, right? This is even, there's a talk about in Saudi, we've seen a lot of talk about whether oil products will be in different currency or et cetera, but there's nothing that we are seeing in terms of developments in that area. And at this stage, the way we're looking at FDI, or in terms of the that is coming into the country, it's coming from all sources. So I don't know.
Yeah, if I may add, you raised an important point about the result of the surveys, that those who were with Russia get less, etc. I think there is some truth in that. If you look in the past 4 or 5 years, take example of Iran, where they had very close relationship with China. And I look at the FDI for Iran, nothing. There was a big talk, 50 billion will come, etc., and nothing happened. So I think for the Gulf countries, also particularly Saudi Arabia, the sources of FDI is very important. It's very crucial to attract foreign direct investment from Western Europe and United States. And I think with the reform process, with the progress being made, that could happen. So far, it has been weak for several reasons that we cited: governance, weak business environment. Only before the 2008, foreign direct investment was very high, and that was mostly more than 3/4 was in the energy sector. Now, even in the energy sector, you don't have enough foreign direct investment in Saudi Arabia. And that brings me to the other issue, whether production capacity of Saudi Arabia is 12 million barrel a day or 11. I doubt the 12 million barrel a day cited by the IEA and other organizations is true. I think Saudi Arabia cannot produce more than 11 million barrel a day on a sustained basis. So far, there has been production of oil for a few months, around 11 and that's could be one of the reasons of the cut in production. This is just my guess.
Okay, we have 2 questions online. Maybe one I'll direct at Amine and the other at Garbis. But for Amine, you mentioned record numbers of foreign tourists, but is there any evidence of the hope for increase to 100 million annual visitors? And if this doesn't materialize, what will be the effects on the job market?
Thank you. That's a target. That's a target in terms of tourists that is also aligned with the infrastructures that are being constructed with the demand. We're clearly seeing that pilgrims are up now with Hajj full, and then we have even domestic tourism that is going up. And the numbers are clearly there that we are already back at above pre-COVID and that rising. Now, when is it that we will reach the target? I guess that will also depend on the infrastructure that is being built. And the jobs will come aligned with that.
Right. But we're already seeing quite strong job growth in the tourist sector, right? Yeah. Okay, so Garbis, for you, a lot of interest in oil production and oil prices. So we're looping back, I guess, 30 minutes on this question. But The question is, what production level and price Saudi needs to balance the budget this year, next, and to meet Vision 2030, but maybe in the medium term? And does it really need to balance the budget? 1% deficit looks relatively good, so is a balanced budget target appropriate?
Yeah. I mean, to balance the budget, it's so now it's related to oil prices, government spending profile, and oil production. If we assume that crude oil production will continue to decline for the next few years because less global demand for oil, etc., and in order to keep it at a certain level, then it will be difficult to balance the budget unless the fiscal consolidation continues. And so far there has been major progress in rationalizing spending, etc. The challenge is the wages now, as mentioned in the IMF report, streamlining wages, moving more public sector employees to the private sector, and this is happening gradually. It will be a challenge to balance the budget in an environment of declining oil production and declining oil prices over the medium term. Most likely the oil prices will not stay at the current level. I don't see any probability that oil prices will stay above $80 in the next 2, 3, 4, 5 years. Beyond even the near term, you could see oil prices even going to $60, $70.
Do you have an estimate of the break-even oil price for the fiscal for this year and next year?
For this year, I mentioned that the fiscal break-even prices of oil is $90 per barrel for Brent. Now, that could decrease next year under the assumption that crude oil production will increase. And there will be further progress in non-oil revenue, which is happening. This is one of the major achievements that the kingdom did over the past several years, that less reliance on oil revenue. The share of non-oil revenue in total revenue is increasing, and that's a positive. And one of the major measures which the Article 4 consultation mentioned 2 years ago, is the tripling of the VAT. This is a bold move in an environment of contraction in the economy to come with such rise in taxes. So break-even oil prices are likely to decline, supported by further decline in government spending and improvement in oil revenue, non-oil revenue. But again, on the other hand, how much of that will be offset by lower oil production? Because these are the factors. In fact, you mentioned it in your interview in one of the newspapers. You cited the main reasons or the factors which come to the formula of calculating the fiscal break-even price.
Well, I don't really like to talk a lot about break-even oil price because there's too many unknowns. But I think one thing that is clear is that in terms of the fiscal stance, one needs to look at it over a medium-term framework of a permanent income hypothesis to try to really maintain and reach intergenerational equity considerations over the longer term. In our calculations, that meant that the overall fiscal balance is probably close to balance or slightly above in our latest calculation. That means that the non-oil primary is still in deficit, but you have that, and what's important there is how you get there. And how you get there should not, and that's, at the end, that's the whole objective of the diversification agenda, is to try to remove to mitigate the risks from these oil price fluctuation, and therefore continue on what's happening on non-oil revenue mobilization. You look at non-oil revenue mobilization, they have doubled over the past 4 years. They are now 12% from where it used to be, 10.5% from, which is doubling over the past 5 years. But there's still quite a lot to be done there. I mean, the tax gap, the way we estimate it, is about 10% of GDP that can still be done. It used to be 15%, so there's been a lot of improvements. But there's a lot of untapped sources on property taxation, on reforming corporate tax, etc., that can also help, on revenue administration, that can really help in increasing this non-oil revenue mobilization. On spending, containing spending, I think a lot has been done on wages. We are not seeing new public sector employment, but let's not forget one big quantity, which is subsidies. Fuel subsidies. Last year, Aramco recorded in compensation 6.2% of GDP. Those are, foregone revenues that could help, in terms of the fiscal stance. So those are some of the priorities on the fiscal and these are central government, again, and, a lot of the spending is also happening by PIF and other institutions.
Let me just pick up. We have a question online in terms of growth of subsidies, particularly of energy. Maybe you could just give a sense of whether energy subsidies are increasing, decreasing, short term, medium term.
Energy subsidies, look, energy subsidies were over, 30 years ago, we were talking about energy subsidies of 12, 15% of GDP. Using the same, metric, we're now talking about 6.2% of GDP. Over the last year, that has increased because oil price went up. That was the number for 2022. We expect, oil price to be, on average, last year's oil prices for 22 were about 102. We expect the prices in 2023 to be lower, so we're going to get some gain in terms of subsidy savings there. But also, the authorities are engaging in these energy price reforms, which means that some of those subsidized products, we've seen some steady increases in prices. For example, diesel earlier this year was increased by 25%, right? There's still a large gap with international prices, but that is part of these energy price reforms that we expect to see continuing. We would like some of it accelerated. We've seen that gasoline, the cap on gasoline prices is there, but I think the reform that the authorities are taking go in the right direction, and with a goal that is actually, this is a goal under Vision 2030, is to remove these subsidies by 2030.
Okay. Maybe we can go to Raymond.
Thank you. I think Amine largely answered my question, but maybe I'll throw it to the whole panel. Are there any, you mentioned a lot of reforms that happen in terms of either regulatory reforms or others to further open up society. Are there any other regulatory reforms that the IMF is advocating for that you'd like to see kind of in the near future to further diversify the economy or revenue in general?
I mean, look, there's a lot in train, and actually, if you look at the regulatory environment over the last 5 years, the transformation is really big. I think the importance here is in terms of implementation. Now the new laws being worked on consumer protection, particularly the new investment code, I think will help. There's also complaints by businesses about the amount of fees. So streamlining these fees, I think, will be something important. And also, in terms of investment, trying to make sure that, whatever progress is made through digitalization in e-procurement, etc., to try to facilitate businesses engaged in that. And obviously, continuation of labor market reforms will be key.
So staying on the reforms and the impact of reforms, so one question is, can you comment on trends in productivity growth?
Look, I think if you look at productivity growth, there was, I think that still needs to increase. I think if you look at throughout the world, there's been a decline in productivity, and particularly after COVID. And I think we've seen a lot of the reforms that we talked about in terms of increase in human capital development, in terms of education, in terms of digitalization, etc. We expect that to have a positive impact on productivity, and so that productivity going forward will have will be an increasing driver of growth.
Yeah, I would share Amin's view that yes, productivity of capital and labor has improved in the past few years for the reasons he mentioned. Another factor is female participation in the labor force, which jumped. And there were many studies in different countries that whenever female participation in the labor force, it increases productivity. And this is what's happening now in the kingdom.
I mean, Garbis reminds me of something in our report that I think could be interesting if female labor force participation, which we've seen quite a lot of progress there, 37%, but if that were to increase to, let's say, the OECD level, we will get
Yes.
a boost in growth of about 1.6 percentage points.
That's
So that's already quite sizable.
Yeah.
Okay, so we have a question on Aramco and the PIF and the implications. So I guess the PIF received 4% of Aramco shares last year, I think, and then a further 4% earlier this year. What's the implications of that transfer from the government to the PIF? And does it mean that Saudi Aramco can still be a main engine of growth for the economy?
Well, Aramco is part of the economy. I mean, and we're seeing this year, there's an announcement this year already of extra dividends going to the government, which would probably improve the break-even price that Garbis was talking about, both for 2023 and 2024. In terms of what are we saying in terms of implications of the budget, I think we clearly see it in terms of the level of reserves, right? I mean, last year, 2023, if you look at the current account, surplus current account, if you want, has improved by $153 billion. If you look at the level of reserves, that improved by only $4 billion, current reserves. The difference is what? Is the asset accumulation abroad through Aramco PIF. So I think we see that there. But that doesn't mean that this is a decision that is problematic in the sense that the level of reserves today are still 80 months import cover. There's still more than 100% reserve adequacy. So that level is still quite appropriate.
Yeah, if I may add, this is one of the strategies has been followed since 2018, where despite the fact that you have large current account surpluses, you don't see official reserves increasing because policymakers say why we have all these ideal official reserves which are invested conservatively abroad in treasury bills or other, where the return is hardly 2 or 3%. If you compare it to the UAE and other countries, most of the public foreign assets are in the form of sovereign wealth fund. And the central bank has official reserves hardly even 8-9 months of import coverage, because you need that only for monetary policy purposes. So you don't need in Saudi Arabia official reserves more than 20 months of import coverage. And this is what's happening, that most of the current account surpluses are going to the sovereign wealth fund, the PIF in this case, and that's in the form of the public investment fund is investing it abroad in global equities where the rate of return is at least 6, 7, 8%. And I think this is a wise decision.
So another question online, maybe Garbis, I'll direct this to you. And I think we at least partially covered this. Saudi officials have hinted at de-dollarization, pricing oil contracts in one or other currencies. What is the likelihood of that happening, and what would be the ramifications for US investment, presumably in the kingdom?
I think it's highly unlikely that we will have a de-dollarization or using other currency in that sense you're saying, because this is one of the issues raised in BRICS and other things. Most oil is being sold in dollar in the market. Most of Saudi exports are denominated in dollars. I don't see, even in the medium term, moving away from the dollar. It will stay at least for the next 5, 6, 7 years. How things evolve with BRICS, China, India, and other countries, whether they will come with another form of currency, there is much uncertainty. But for the next few years, I don't see de-dollarization happening.
Okay. And then a question about exports, and I guess related to diversification. How alarmed should the authorities be about the 32% decline in non-oil exports in the 12 months to June?
So, if we look at non-oil exports, they were $85 billion in 2022. That was actually a record in terms of non-oil exports. If we were to look at the performance of non-oil exports in terms of diversification, used to be 90, oil used to be 90, so non-oil exports have now, the share of non-oil exports have increased to 25%. Still low, but still quite a lot of progress from the 10% that used to be just 10 years ago. Now, this year we've seen that drop. I think it's still too early to look at the trend, but it seems to be driven by what's happening in terms of China demand for some of the products. A lot of these non-oil exports decline that we've seen in some of these petrochemical products, and that seemed to be reflecting a decline in demand. So let's try to see, we're now seeing a pickup in some of that external demand, and so that would be, let's see how sustained that would be before we can update our numbers on this.
Yeah, if I may add on this non-oil exports. In Vision 2030, the objective was to raise the share of non-oil exports in total export to 50%. As Amine said, now it's 25%, so it used to be lower in the past. And whether this is achievable is it's a big question, because most of these non-oil exports are petrochemicals, and these are related to oil prices also. So the challenge for Saudi Arabia is to come with new products to export them, and this will be needed in the diversification process.
Okay. So I guess we're beginning to move to the end of our time, but there are a couple of questions online that I think broadly about, performance accountability of the reforms, whether Saudi is going to be a huge success story as claimed by the Crown Prince. But maybe let me put those questions in a broader context and ask you both. I know both the Article 4 report and Garbis work you've been doing has been looking at the the achievements under the Vision 2030 reforms. What has gone well and been achieved, what maybe has gone less well and hasn't yet been achieved. So maybe you could both just conclude by giving a broad assessment of how you see the status of the reforms and where we're beginning to see impact in terms of I think the overall goal of diversifying the economy and creating a stronger private sector. So maybe start with you, Amine.
Thanks. Tim, this is like a very broad question, which one could stay and write a dissertation on. But if you look at the performance, and I think when you talk about accountability, maybe something to really flag is that in Saudi Arabia there's this strategic management office that really follows up on Vision 2030 and all the objectives. We have an annex in our report that look at the different objectives. There are so many in terms of investment, in terms of targets for digitalization, targets on diversification. I mean, if you look at diversification, clearly, non-oil revenue as a share of total revenue is now 60. It used to be, oil revenue as a share of total used to be 90, now it's 60. Oil in share of terms of GDP, in terms of in the economy, used to be 45%, 10, 15 years ago, it's now 15%. We just talked about exports, where non-oil exports are now 25% compared to 10%. So we have seen progress in diversification. We are seeing there are a lot of targets in terms of digitalization that are surpassed. I talked about the targets in the labor market where female labor force participation, the target was 30% for 2030. We're already at 36%. So already there are some updates that need to be made and revisions. I've seen, I think there was a discussion raised by the Crown Prince in terms of already talking about when is the 2040 vision going to come in terms of the new targets that could come in. There's, in terms of, there's still a lot to be done, obviously, in terms of investment, in terms of growth. I think there's very ambitious targets in terms of investment, but also it's important to note that when these reforms are happening, let's not lose the ball on the macroeconomy and making sure that those macroeconomic policies that have been quite prudent continue irrespective of what happens in oil price developments. And if you look at our growth projections on non-oil, and they remain quite strong at 4% and above, these are all contingent not on what's happening with oil price, but they're all contingent on these reforms continuing and not stopping. That would be the biggest risk.
Okay.
Yeah,
Garbis.
I mean, initially the Vision 2030 was very ambitious. It was drafted by McKinsey Global Initiative, where they set very ambitious target. From the beginning, we knew that will be very difficult to achieve. But nonetheless, so far, there has been major achievement, whether it's female labor force participation, unemployment rate declining, non-oil revenue to total revenue improving a lot. But the main concern that I have, which I mentioned, is the FDI. It's still 1% of GDP. It didn't improve that much. Another concern, when you say in the Vision 2030, oil sector in total GDP would drop from 43% in 2013 to something like 11% in 2030. That's very ambitious. I mean, even now it's still a bit 37% or so, depending on oil prices. So such diversification away from oil will need a faster growth in non-oil real GDP, something in the range of 6 to 7%, to achieve such a diversification away from oil. At the same time, oil production declining, which means the oil GDP is less, so you will see that. And whether that's possible to achieve a growth rate 6 to 7% comes the issue of productivity, further improvement in total factor productivity.
Very good. So I'm going to bring the discussion to a close. Let me thank Amine and Garbis for a very, very nice discussion there. Thank everybody in the room, and thank you who tuned in online as well. Thank you, and have a good rest of the day.